What's up, everyone? It's Eric with Option Edge, and today I want to talk about put debit spreads, aka bear put spreads. Okay, I have a PowerPoint presentation prepared. Before we get into that, I want to show you an example of what a put debit spread is on an option chain, just so everything makes sense when I start explaining things. So what we did is we bought a $435 put. Okay, now remember, a put by itself. If you buy a put by itself, you want the stock to go down. But what we're doing is we're buying a put and then combining the put by selling another further out of the money put. So we are selling a $430 strike put, and then simultaneously we're buying the $435 put within the same expiry of September 17th. Okay, and if you notice, the strike price or the share price of the stock is currently trading at $438.21. Now with puts, as we move down in price, we get further out of the money. Okay. Now, if you don't know what out of the money, in the money, at the money means, I will make a video explaining about that. But we have a video referring to Delta, which goes over that. And check out the top. You'll find I'll link to the Delta video I just made. Anyway. So you can see that the $435 put that we bought is worth more than the $430 put that we sold. Okay, so what happens is the $435 put offsets. The price is offset. So you have it's almost $900 minus the almost $750 put for a total cost of almost $1.50. So we're at $1.43. So that's the example, and then you can see our break evens down here. If the underlying gets down all the way to $430, that's when we make our max profit. Anything higher, we're capped. We don't make any more. Still the same profit. The most we can lose is the total cost that we paid for. So let's go into the PowerPoint and go over things in more detail. Okay, so we have put debit spreads. So over here, I wrote put debit spreads / bear put spreads. And the reason why it's called a bear put spread as well, besides a put debit spread, is because if you purchase a bear put spread, you are bearish on the stock. You want the stock to go down. And the further the stock goes down, the more money you make. Besides when you hit the lower strike, which I showed you before. So yeah. So a put debit spread is a type of vertical spread. And I've talked about a couple different vertical spreads before, and I will link them up top somewhere. So you have technically two different types of vertical spreads. You have credit spreads and you have debit spreads. So today we're talking about put debit spreads, but you can also have call debit spreads. And in my other videos, we talked about credit spreads. You can have put credit spreads or you could have call credit spreads, okay? So technically, it's sort of four different combinations of vertical spreads you can technically have. But anyway, let's go over the formal definition of a vertical spread. A vertical spread involves the simultaneous buying and selling of options of the same type, i.e. either puts or calls. So today we're talking about only puts. The expiry is the same, but we have different strike prices, okay? So the term vertical comes from the position of the strike prices. And if you saw in the example, we have the $435 put is above the $430 put, okay? Next slide. So we're going to start, in order to build out a put debit spread, we will start by buying a put that is closer to the money. Now, in our example, we saw that the $435 strike price was closer to the underlying stock price. The underlying stock price was at $438. So we buy the closer to the money, more valuable put, and then we're going to sell the more out of the money, less valuable put. And now just think back, the put we sold was about $750, and the put we bought was about $900. So we're buying the more valuable and then selling the less valuable, which leaves us, the two subtract, which leaves us with a net debit. And let's go over what that exactly means. So the short puts value will subtract from long puts value. Overall, the option strategy is a net debit as opposed to a credit. This is a long position, okay? Now, credit, when you hear debit, think net long, And then when you hear credit, think net short when it comes to the vertical spreads, okay? And the reason why we say net is because we are longer, the put that we bought is more valuable than the put that we're selling. Therefore, it's net long, or net long put, okay? So long put value minus the short put value equals the total put debit spread value, okay? That's the pricing. All right, so we're referring back to our SPY example, buying the $435 puts priced at almost $9, and then we're selling. That should oops, let's go back. That should say that's wrong. That should say selling the $430 put, not call, for a price of $7.52. Overall, the put debit spread value is $1.43. Okay, we've gone over that. So another thing we can go over is the delta of the put spread. So let's go back to, well, we can show it right here. So the 435 put delta is negative 44.47, and then we're short the 430 put delta, which is about 37. Okay, so overall you subtract the two and you get a net delta of about 7. Okay, so it's like being short 7 shares of SPY. So this is a little more advanced topic, and I know I have some typos there. So here's how we calculate max loss. Okay, so this is very simple. The max loss is just going to be the net debit paid. Okay, the most we can lose, since we are longer than we are short, the most we can lose is the amount that we actually paid. Okay, so it's $1.43. Next slide. So the max profit, this is a little bit more tricky. So you take, in order to get, in order to calculate max profit, you take, so this says max loss, it should say max profit. You take the spread between the strike prices minus the net premium or the net debit we paid, okay? So the spread between the two strikes, we have 435 and 430. The spread's going to be 5, okay? Because 435 minus 430 equals 5. You take that, the spread, the difference in the spread, and then you subtract the net premium paid or the net debit, okay? So we paid $1.43. You subtract that from 5, and you get $3.57. That's the max we can profit, okay? And we'll check this at the end back on Robinhood. We'll look at max loss, max profit. Our break-even point is going to be the strike purchase. So we purchased the $435 strike. We sold the $430 strike. So we want the $435 strike. It's going to be the strike purchase minus the net debit paid. Okay, the net debit paid. So that's another typo. But so $435 is the strike we paid for minus the debit paid. It's $1.43. We're going to get a break-even point of $433.57. That's the end of the show. Sorry about the typos, but let's go back to the option chain and let's expand that. So now let's go over max loss. So you can see here, max loss is the total cost. We paid $1.43. And let's go to break even. The break even is going to be we're going to take the strike we bought, the $435 strike, and then subtract the net debit, okay? And that's going to equal $433.57. The max profit is going to be the strike we bought, the $435, or excuse me, it's the difference between the strikes, $5, and then we subtract the total cost, and that's going to yield us $357. Okay, as you can see there. We'll switch back. And that's it. That's bear put spreads, put debit spreads, okay? If you have any questions, please comment, like, subscribe, do whatever, and it's much appreciated. Oh, there goes my dog. Adios.